Walmart, a legacy physical grocer famous for those massive concrete parking lots, is currently trading at a software-like valuation. I mean, the market is literally pricing this traditional brick-and-mortar retailer like a high-growth tech platform. So do the fundamental mechanics actually support this massive premium, or is Wall Street setting itself up for a brutal reality check? Well, in this explainer, we're going to look under the hood to see exactly what the market might be missing. Okay, let's just dive right into this number. 36.1 times earnings. That is an absolutely unprecedented multiple for a company whose primary engine is selling groceries to value-conscious consumers. This single number tells us Wall Street has completely bought into Walmart's new digital engine. But there are some hidden earnings risks buried deep in their latest report. And as you'll see when we run the 5-year math, the margin for error at this valuation is exactly zero. Now, to really understand this premium, we first need to wrap our heads around the sheer concrete scale of this business. If Walmart were a country, its $713.2 billion in annual revenue would make it one of the largest economies in the world. They're serving roughly 280 million customers every single week. This is top-line scale that rivals Amazon. And it's been anchored for decades by one simple but incredibly powerful value proposition: everyday low price. So how does that massive $713 billion actually break down? Well, Walmart US is the absolute juggernaut here, making up 68% of sales. Then you have Walmart International holding 19%, capturing growth in massive markets like India. And finally, Sam's Club US brings in the remaining 13%. But here's the catch we need to talk about. Almost 60% of domestic revenue comes from grocery and consumables. That drives incredible volume and foot traffic, for sure. But historically, the profit margin on a gallon of milk is razor thin. And that brings us to the bull case. It's the whole reason this stock trades 36 times earnings right now. Walmart is fundamentally transforming from a traditional low-margin physical retailer into a highly profitable digital service platform. They're totally pivoting the economic engine. They want to monetize the entire transaction ecosystem, rather than just making a few cents on the physical products themselves. Just look at the sheer contrast in profitability here. Notice the top line. Traditional physical retail yields a 15 to 20% gross margin. But when you look beneath that, global advertising, driven by Walmart Connect, operates at roughly 70% gross margins. And membership services, like Walmart Plus and Sam's Club, are essentially pure profit, dropping to the bottom line at over 90% margins. When your advertising revenue is growing 38% globally, it completely redefines the company's profitability profile. This entire pivot is being fueled by a staggering e-commerce engine that hit $150.4 billion, growing at 23% year over year. But, it's not just about top-line growth. Management has now actually automated over half of their fulfillment volume. By rolling out automated freight systems across their stores, they are radically lowering last-mile delivery costs. That automation is literally the magic key that is finally unlocking double-digit incremental margins for their digital sales. And this isn't just Walmart playing catch-up. It's about leveraging a structural moat that even Amazon struggles to replicate efficiently. Walmart's true superpower is using its 4,600 physical U.S. stores as a massive decentralized last-mile fulfillment network. When you combine that logistics footprint with their unparalleled pricing power over CPG suppliers, plus the ecosystem lock-in of memberships and first-party ad data, you have an incredibly defensible fortress. But here is the central conflict. This is the exact question keeping smart money awake at night. Can this high-margin digital growth scale fast enough to offset the decay in their traditional physical business? It's basically a race against time between these booming digital platforms and a core lower-income consumer base that is currently facing immense economic pressure. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed. Because the bear case here is actually highly intelligent. The market is pricing Walmart for perfection right now, expecting tech-like margin expansion. Yet Walmart's domestic grocery market share actually slipped recently, from 21.1% down to 20.4%. Why? Because higher-income shoppers are hunting for bulk value over at Costco, while younger demographics are discovering products on emerging platforms like TikTok Shop. So digital expectations are sky-high, but the physical transaction environment is clearly slowing down. Let's look at the latest Q2 fiscal 2027 earnings report for the quarter ended July 31st, 2026, and announced on August 20th, to see exactly how this conflict is playing out in the hard numbers. On the surface, the quarter looked absolutely flawless. Total revenue beat consensus at almost $188 billion. Adjusted EPS hit 81 cents, completely crushing analyst expectations by 9.4%. Gross profit margins expanded by 96 basis points, so almost a full percent, to 25.4%, and U.S. e-commerce surged by a massive 24%. By all traditional metrics, this is a spectacular print. But as always in investing, we really have to read the footnotes. Turns out a massive chunk of that margin expansion wasn't organic operational brilliance at all. It was actually a non-recurring tariff refund windfall. This one-time event provided an artificial 750 basis point benefit, a 7.5% bump to their Q2 operating income. Now, management did smartly reinvest that windfall into 11,000 price rollbacks for their squeezed consumers, but it effectively masks some real underlying margin pressures in their core business. And this one-time boost created a glaring contradiction in management's commentary. On one hand, they raised full-year guidance, expecting net sales growth of 4 to 5%. Sounds great, right? But on the other hand, they issued a noticeably cautious outlook for the upcoming third quarter, projecting adjusted EPS of just 62 to 64 cents. That came in well below Wall Street's 68-cent consensus. And here is the real pattern interrupt. Despite beating estimates and raising full-year guidance, Walmart stock dropped over 9% on earnings day. Wall Street looked right past the tariff smoke, saw that soft Q3 guidance, and realized domestic comparable transactions had decelerated to just 1.5%. Listen, when you're trading at 36 times earnings, 1.5% transaction growth simply doesn't cut it. So, stripping away the daily price action, how strong is the underlying business? Well, using our research framework, Walmart scores an overall 7.7 out of 10 for business quality. It's obviously a highly durable company, but that score reflects a real tug-of-war between their elite execution and some serious structural headwinds. Breaking that score down, they easily earn 9s for both track record, with 10 consecutive years of top-line growth and business viability, since this is basically essential consumer defensive infrastructure. Management alignment sits at a strong 8, largely anchored by the Walton family retaining roughly 46% ownership. But the anchor dragging the whole score down is profitability, sitting at a 6. That thin 3.1% net margin leaves them highly vulnerable to minor shifts in logistics costs, fuel prices, or just transaction frequency. A quick heads up, all of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for literally any public company in the world, completely free at flash.sentinel.ai. The core company research is free. Now, if you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, quality businesses built to compound for years, hidden gems, under-the-radar names with asymmetric upside, and dividend hunters, durable income with the fundamentals to back it up. There's also Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right here. Scan it to download the Flash app and try it yourself, or just access Flash on the web at flashstocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. Okay, let's look at where the stock might actually go from here. First, I need to clearly state, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. All right, let's run the math out to fiscal 2031. The high case requires absolutely flawless execution, driving a 3.6% net margin and supporting a premium 30 times multiple, which gets us to a share price of about $139. The base case assumes physical retail drags just slightly, keeping net margins flat and compressing the valuation multiple back to a more historical 26 times earnings, dropping the price to $96. And finally, the low case assumes lower income consumers really break, margins compress down to 2.3%, and the multiple collapses to 18 times, leaving the stock at roughly $43. Applying probabilities across those scenarios reveals a probability-weighted future price target of $96.25. Think about that for a second. Even when you factor in 5 full years of cumulative dividends, that leaves an investor with an annualized return of negative 0.32%. This is the mathematical reality of a stock being priced for perfection. Multiple compression becomes your absolute biggest enemy. Now we have to talk about the concrete threats that could actually break this bull case. First up is the massive CapEx burden. Walmart has to spend upwards of $28 billion annually just to fund and maintain this automation mode. Second, their pharmacy margins are facing direct regulatory deflation from the new IRA maximum fair price rules. Combine that regulatory hit with a squeezed lower to middle income consumer and relentless competitive pressure from Amazon's Prime ecosystem and Costco's bulk dominance, and suddenly that 36x multiple looks highly precarious. So, what's the crucial point you should take away from all this? Well, the bottom line is threefold. First, the digital transition is absolutely real and it is driving true structural profit growth. Second, do not be blinded by headline beats. This past quarter was heavily masked by a one-time tariff windfall. And third, the 36x valuation leaves zero room for execution errors. Going forward, the single most important metric you must watch is domestic comparable transaction growth. Look, Walmart is undeniably a stronger, more sophisticated business today than it was 5 years ago. But the market already knows that, meaning the upside from here requires them to significantly over-deliver in an increasingly tough economic environment. So you have to ask yourself, is the digital future already fully priced into today's shares? If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.